you are co-founder of Gateway Merchant Banking, a national real estate investment platform. Sounds exciting. Talk to me a little bit about that.
Yeah, sure thing. I'll give you the quick overview of Gateway and who we are and what we do. So co-founded Gateway with Charles Frazier way back in 2015 at this point. And what we launched is really a national real estate investment shop that right now is currently focused on developing multifamily product across the country. We have delivered a project in Washington, D.C., Trellis House, 319 unit project that was very well received, great performance, and had a great round trip. And we have used the success of that project to really codify our business plan and launch how we are approaching the real estate market nationally. We currently have a couple of projects moving through pre-development with groundbreaking scheduled for fourth quarter of this year. So look for us in suburban DC, look for us in Kansas City, interesting market. I'll tell you about that some other point. And then we have some other things where we're looking in New Jersey and the Metro Atlanta area as well. So when we say national, we're a truly national firm. We've been primarily focused on development, but we also see a number of opportunities now from an acquisition lens. And those will be things that we'll have more to say about as we roll into calendar year 2023. But definitely we'll be utilizing our market knowledge and capabilities to start acquiring existing assets as well.
Brilliant move. Let's talk about Kansas City, a city that you may hear about depending on where you live in the country. Definitely Gateway City, which is interesting that you guys are there. What brought you to Kansas City?
You know what? Actually, part of our business model is to partner with local developers that need someone who can come in with a full turnkey multifamily design, build, finance, execution capability. So we were asked to join a 30-acre master plan that the city of Kansas City is sponsoring in partnership with a major hospital there in Kansas City. And so we will be part of the first phase, building 250 units of multifamily product as part of this larger master plan, which will include office, retail, and hotel right there in Kansas City.
That sounds exciting.
It is. It definitely is. And it helps when people say you don't fight City Hall, but it definitely helps when City Hall is motivated to bring large scale development and where you have private corporations working in concert with the city to see an area redeveloped.
How do you feel? You guys are obviously a key piece of that redevelopment. How do you feel your role as developer and investor kind of plays into making that happen for Kansas City and the other cities you mentioned?
Well, so look, the interesting and great thing about multifamily is you bring the customers for every other component that's coming into these types of development. And that's why we are part of the first phase of the development. And so for us, it becomes very important for us, one, to stay on schedule, because other phases are dependent upon us hitting our timelines. But it's also very important to plant a flag and show that this is an area where people want to be, and that helps attract the retailers that will come in the phase 2 and 3 of the development. So we're the catalyst that proves the market and brings everyone else along.
That's great. And how do you feel that development and investment is moving as some of these markets that may have been overlooked or are climbing that kind of growth chart are moving? How do you feel development is going to go?
Yeah, look, I think that with the low yields and real assets that people have seen over the last, certainly over 2.5, 3 years, and the declining yields that people have seen over the last, 10 years plus, I think this notion of kind of flyover markets is something that we all need to put to bed. I think that you have to look at the growth in the broader market, but you also have to look at the very specific situations that you're investing into. And from there, you figure out what your opportunity for success is. And again, we have a unique situation in a city that people don't talk about it very much, but in a city that has a very, very significant healthcare infrastructure, has nationally known major universities, has a very young population. They actually retain a lot of their college grads, whereas a lot of cities, Philadelphia, for example, can lose a lot of their college grads. And so Kansas City has evolved into a market where there's something going on there. Now, do you need to build 2,000, 5,000 new units a year in Kansas City? No. But can you build 1,000 that are well absorbed and continue with incremental price increases over time? Yeah, absolutely. And those are the types of plays that we're looking for: higher current yield and more opportunity on the back end than you may find in some of your more established markets.
So connecting to a point you just made, how do you get to connect with local talent and partner with local talent to make some of these projects, bring some of these projects to fruition?
Yeah, that's what's amazing is you just have to show up. The reality is major investors crowd into certain markets over time, and that leaves other markets looking for capital and looking for people who are willing to come in and really partner with the communities. And that can quite often scare people away from a development standpoint. But from our standpoint, we look at it as a competitive advantage. We want to come into a community and lay a ton of road in front of us before we break ground. We want everybody to know we're coming. We want everybody to know that we're bringing a Class A product so that we create demand and we create anticipation as we're looking to lease an asset up. And so part of that happens by extending yourself to the community and letting them know, hey, we're here, for lack of a better word, we're here for good. And for our investors, what that means is we're de-risking the deal by removing some of the local zoning and municipal obstacles that you can have that can throw off your schedule and then ultimately draw down returns.
Right. So by being involved early and being very involved, you pull a lot of risk out of the deal by simply being there.
Absolutely.
That makes a ton of sense. So you did mention one of your home runs, which is the Trellis House, the 319 units. How did someone build 319 units in DC?
You know what? DC is an interesting place to try to get something done, because the backstory on that is we actually started with the plan to build 110 units of student housing. As we spent time getting to know the neighborhood, literally sitting on couches, getting to know the neighborhood, what we realized is that the neighborhood was actually changing faster than we even realized. And we were building right next door to Howard University. And we actually went to Howard and solved the problem for them. They had lots that they owned that were not contiguous, and they could not develop anything meaningful. And so what we brokered a deal with them to say was, we will combine the land that we control with the land that you control And that gave us the opportunity to go from a 110 unit student housing deal to a 319 unit Class A multifamily deal.
Right.
And then the other thing we did, and this is about when we're talking about engaging with the community, the site was at a 1 point, I think we were at 1.6, no, 1.8 FAR when we started the process. We were able to get the site upzoned to a 6.0 FAR. And that was only because we did the upfront work with the community and got their support for the rezoning. So that's what I say when I talk about de-risking a deal through engaging with the community.
Right. So you took a lot and turned it into a real project.
Right.
So you have the formula.
We think we do.
You have the process, right? You have the talent, obviously. So where does Gateway go from here?
Look, so our business plan is very focused now. What we're looking to do is scale nationally as we are doing, and we're looking to be at a point where we're building 3 to 4 Class A market rate multifamily projects a year. And we're looking to also add on 3 to 4, people like to use the word attainable housing, but what we're really saying is we're looking to build into the gap of kind of 60, 80, 100% AMI. Because what you find is there are a number of very great federal and state programs that are targeting renters that are earning kind of 50% and below of AMI. Right. And then you have your national merchant builders that are cranking out product for those that are, 120% AMI and greater. And so what you have is this big hole right in the middle of what are true kind of working people. So this is when people start talking about your nurses, your firemen, your policemen, your teachers, that's where they fit, kind of that 80% plus or minus AMI. And what we're doing is we're looking for opportunities to build product that suits their needs. And we're using the same process and the same formula from a construction standpoint that we're doing for our Class A product. Brilliant,
brilliant. So there will be a Gateway house near me very soon.
Hey, look for Trellis House wherever you go. How's that?
There you go. I like that one better. Great talking to you, Terrence. Thanks a million. Right. We'll connect. Hey, Terrence, how you doing?
Hey, Gard, I'm fantastic. How are you?
Good, doing well. Enjoying the day. I'm enjoying the day. So everyone, we've got the co-founder of Gateway Merchant Banking, a national real estate investment platform, here today, Mr. Terrence Murray, and he's going to be discussing capital markets with us and with the Baruch real estate finance class. So Terrence, if you'd like to introduce yourself to the class and get us kicked off.
Yeah, sure thing. First of all, thanks for having me. It's an honor to be here. I'm really excited to be able to talk to you in your class. You could not have picked a more interesting time in the last 2.5 years to have this conversation, given what just happened with the Federal Reserve and the rate hike, and what's potentially coming down the pike in the next month or so with another potential rate hike and further tightening from a monetary policy standpoint. So very exciting time, very interesting time to talk about capital markets, very interesting time to talk about capital markets as it relates to real estate, specifically one of the most capital intensive businesses there is, and one of the most rate dependent businesses there is. So glad to have the conversation. Not sure I have a ton of great answers, but I'm glad to give you my perspective on what we're seeing in the market.
Perfect. Thank you. Yeah, it's definitely an exciting time. So just Let us know where you got started, how you got started in the business in our industry, and then what led you to capital markets and a little bit of what you're doing now.
Yeah, sure thing. You know, for me, real estate in particular is almost a never-ending story. I've been interested in real estate from an extremely young age, and I was lucky enough to have a dad who was a banker, and so I was, you know, growing up, I heard little things about finance. I heard little things about banking. I heard little things about merchant banking. And so that was kind of in the background as I was thinking about real estate from only a development standpoint. And the two worlds actually came together for me in my early internships. So during my early internships, I was actually interning with MetLife Securities in Atlanta. And what I was doing during the summer was working in a trade settlement group. And we were settling trades, daily trades, Fannie Mae, Freddie Mac, Ginnie Mae bonds, and Treasury securities. And as I was sitting there during the summer, this was the first time that I had any exposure to real estate beyond the hard asset. And as I'm talking to the traders in New York, I'm sitting in Atlanta, you know, I'm 19 years old, whatever it was at that point, and it's occurring to me, wait a minute, we're settling the trades. These guys are doing the trades. New York is where I need to be.
Yeah.
And I was lucky enough to find a road as I was trying to pursue that interest, and was able to intern at Morgan Stanley the summer between my junior and senior year. Sat on a preferred stock trading desk. Again, just a complete eye-opening education for me. But the real estate component of it was always at the core of what I was looking for. And just to tell you how your passions find their way to the surface, sitting on the trading desk one day, I heard through what they used to call the hoot, but it was a intra-floor intercom system basically, and heard someone talking about a trade that they were putting together for a real estate deal.
Okay.
And I did not know, even though I was sitting on a trading floor, that this thing called real estate investment banking existed. And I jumped up from the desk on the floor at 1585 Broadway at Morgan Stanley and said, where's that happening? What is going on? And I ran upstairs and found Bill Lewis, who was running, I think he was actually running all of corporate finance at that point, but had been running the real estate group. And now, I mean, it's like,
yeah,
the finance is there, the real estate is there, it's within the investment bank. And when I went back to Florida A&M for that senior year, you know, my focus had changed quite a bit. And I was really looking for a job on the street in investment banking. And I was able to find that and did 3 years as an analyst, went back, got an MBA from Wharton with a focus in real estate. Again,
great.
Lucky and fortunate that I was able to spend my summer with DLJ, and then went back after the merger and worked for CSFB. And then from there, you know, just career progression has given me the opportunity, as I always like to say, to kind of finance or transact on almost any component of the real estate industry that you can think of. And when I say that, you know, kind of jokingly say it, but it is factually true. I financed everything from cemeteries to high-rise office buildings to, you know, single-family homes to, you know, Italian hotels, you know, you name it. I've had the great fortune to be able to touch the industry in a number of different ways.
That's
so
awesome.
That's, you know, that's some of the highlights of how I found myself kind of blending my lifelong passion for real estate with an intense focus and interest in finance.
Awesome. Awesome. It's exciting.
Oh,
Definitely exciting. Going through it, kind of running the gamut, finding your passion while you were sitting in a place that was adjacent to it,
right.
where you were open to opportunity. And once you heard it, literally heard it happen,
Exactly.
you were able to run toward it. That's great. And I teach my students to try to recognize opportunity where they're sitting as well. So you've definitely run the gamut in terms of capital markets. You've been in leadership positions within the capital markets in some of your roles. Can you explain to the students what capital markets are, especially when attached to when discussing real estate finance?
Absolutely. And here's the great thing, I think, for students who are interested in real estate. The real estate capital markets is, I would say, as a formal function, is probably at this point, I'll call it 30 years old. And what I'm saying is, from a there was always real estate being financed, but from the aspect of really using the public markets to source equity, that's something that really happened as publicly traded REITs really started moving towards the forefront of how to capitalize real estate. And that happened really coming out of the S&L crisis, as people were looking to recapitalize large portfolios of real estate. So that was when things started moving to more of a sophisticated, true capital markets capability for real estate. And then from there, you kind of take it through the 90s, the equity markets starting to open up. The name everyone knows is Sam Zell. If you're a student of the history of this, the name you should go back and look at is Taubman, because they were really the ones, as they moved their mall portfolio to the public markets, that really kind of were the real catalyst to get all of this kind of going. But you kind of take that through the 90s, and then you get to the point of this securitization thing that happened, where we were able to layer asset-backed technology on top of large pools of real estate assets. And a lot of people give credit to Ethan Penner for that, and there are others that helped kind of push that to the forefront. And so what you had happening is, just as I was starting my career in the late 90s, you have the CMBS market, nascent, but really coming on extremely fast. You have the equity markets for real estate, a little more developed, but still, that at that point there were no REITs in the S&P 500 like there are today. Right. And so as you look at what has happened, I'll say from the year 2000 to 2002 until now. So really you have kind of a 20-year run where you've had, I'll call it 3 recessions during that time.
Right.
And so you've had this industry that has been maturing as the world has been changing around it. And it is, and for me, and this is why I say this is a great industry for students, it is as mature as it seems. It still is not as mature as it will be 20 years from now, because we have people still in this business who started, whatever innovation we're talking about, right? And so now things that people are looking at, ground leases, right? How much room does that have to run from a financing capability? We think we've done all we can do with CMBS, but I think there's probably still more to do. Sure. Debt funds just did not exist in the way they exist now, just 6 years ago, 7 years ago. They're really a product of the great financial crisis and banks having to um, really kind of from a capital reserve standpoint, having to take real estate assets off their books. And so that capital had to come from somewhere. And so the industry innovated around, let me take this debt fund model that people have been using for middle market businesses, forever. And now let me layer that on top of real estate assets. So I can go on and on with different kind of anecdotes about how creative and how innovative this industry is.
Mm-hmm.
And again, why I think that this is a perfect place for finance students to be, because you have this industry, again, that I will say is one of the most capital intensive industries that you can pick. And it's constantly changing and it's constantly having to adjust to rates. And we get days like yesterday,
Right.
where the market at one point drops 900 points, right? And you're sitting around, and if people are scratching their heads and saying, well, is anybody going to be able to afford to buy a house in the next 2 years, right?
Right.
Real estate touches everything. And that's why there's so many different capital market applications to what we do.
Right. Brilliant. Yeah, you can see, as you were talking about it, the changes and the innovation in a relatively small period of time. And I think capital markets has just a tremendous runway, with CMBS, and especially with, as we start to look into different types of financing and different types of structures, it's, sky's the limit almost.
Right.
Yeah. So just a quick question. Do you feel like the industry, the capital markets industry, changes more around times of difficulty? And I don't want to say pandemics, right? But a pandemic could be one of them, but just almost disaster, right? So we have a financial disaster, we have, obviously the pandemic, and then the market shifts because it has to almost. What?
Yeah, I absolutely do. For me, the greatest opportunity for me in my career came as a result of the great financial crisis. I was sitting in the capital markets seat at Prudential Real Estate Investors when the music stopped, and we weren't doing new acquisition deals. At that point, what we were doing was trying to think through how to keep liquidity going to our existing portfolio, how to work with our partners to keep them well capitalized and to keep the projects that were in the ground moving. And then for the projects that were being delivered right into the teeth of that downturn, we had to figure out, well, how do we keep these projects afloat? How do we do this and not default on billions of dollars of debt? And so when you're sitting in a capital markets seat, those are the challenges that you're faced with. And when you're thinking about your portfolios, that's when you have to start getting creative. That's when you have to start thinking about and really kind of looking out to the broader finance industry and thinking about, well, what financial technology is being used in specialty finance today? Okay, so small loan securitization. Well, let's see. I have all these assets on my books that have, debt on them to the tune of $1 million to $2 million. Okay, well, you know what? Let's securitize that in the same way that you would for a small balance receivable pool. Let's finance that in the same way. So you have to grab from all of these different parts of the broader capital markets to figure out how to bring liquidity into the industry. And so, yes, I do definitely think that as the markets feel turbulence, people who are thinking about the capital markets role have to be nimble and have to kind of think about how do we continue to get liquidity to the assets and how do we protect the portfolio long term.
Right, right, because we are the one business that can't stop moving.
That's right. That is correct.
So I've got a bunch of questions from students here. I'd like to get into a couple of them. They were gracious enough to grace us. One of them, so in your role at Gateway, what's an example of your day-to-day operation and what are you in charge of?
Yeah, sure thing. So let me step back and tell you a little bit about what Gateway is. And so I mentioned, this lifelong, desire, passion, interest, whatever word we want to use around real estate and the physical asset. But then I had this great career arc where I worked in really some of the best, I'll say real estate organizations, but some of the best finance organizations, asset management organizations in the world. So I mentioned interning at Morgan Stanley. I mentioned DLJ and Credit Suisse. I was lucky enough, MetLife. I was lucky enough to work for Prudential Real Estate Investors. I was lucky enough to actually go through credit training at the Chase Manhattan Bank before it was JP Morgan. And I was lucky enough to work at this place, Varde Partners, which really brought me out to not just focus on real estate assets, but I worked globally across especially finance, oil and gas, real estate, shipping, you name it, Varde touched it. And it gave me an opportunity now to really connect all of the dots around where our asset sits in the risk return spectrum that CIOs are paying attention to on a regular basis, right? Because as you talk to your students, one of the things you should talk to your students about is there is someone in the CIO seat that is sitting at the top of these very, very large asset management organizations every day, waking up, making a relative value decision, meaning I'll use yesterday as case in point. For the last 2 years, most CIOs were, I would say, underweight fixed income. Why? Because the yields were so low that they just weren't getting enough current income to meet the actuarial returns that they need to satisfy, from an insurance company standpoint anyway, to satisfy their long-term liabilities. So a lot of that capital moved its way into the equity market. That's why the equity market has had, part of why the equity market has had such a great run. Well, some of that run was, further enhanced by easy monetary policy from the Fed. So now things are starting to swing back, and I won't even say starting to swing back, but had kind of a big kick yesterday as now rates are starting to rise. And so now you start getting to a relative value standpoint of, okay, well, if rates are rising, well, value is just the net present value of future income. But now if I'm discounting that at a higher rate, well, now my future income just isn't worth as much, right? That means my asset isn't worth as much. So now maybe I want to invest in some more current pay options. So now people will start looking more at the fixed income market, and that will help bring down some of the valuations from an equity standpoint. How does that relate to real estate? Well, people got comfortable over the last couple of years saying in the multifamily space and the industrial space, you know what? A 4 cap rate is probably okay, because if I'm getting 4% current return relative to effectively zero in the fixed income market, well, I'm 400 basis points to the good. So there's a lot of money that could afford to come into real estate. And so now what we as an industry are going to have to figure out is, as we have inflation, how much rent growth will we have to offset that higher discount rate that is somewhat eroding long-term values, right? As complicated as we try to make finance, they're really only a couple of inputs,
Right.
and we just move them around the page, just depending on what we're talking about.
Right.
It's just a few inputs to deal with. And so those are the challenges that people are going to have as they look to rebalance their portfolios and as they look to figure out where to invest over the next, I don't know, if it's a year, if it's 18 months, kind of where that capital goes. Some people are saying that equity markets will net be up, kind of net positive by the end of the year as the world adjusts to these higher rates. Some people are thinking that, they throw out the stagflation term and say, well, this could go on for, 18 months to 2 years. But from a long-term investment standpoint, one of the things that I've learned by living through, even as a kid, but living through the recession in the 90s, which was a real recession. And I say it that way to say, and then we had a recession in the early 2000s, which was, I'll call that one more of an adjustment relative to, yeah. And then you had the great financial crisis, and now you have the pandemic. What I've seen, in my lifetime, and just anecdotally, is the market has, 4 to 6 months where it freezes as it tries to figure out where to reset. It'll have another, 12 to 18 months as people kind of shake out on either side. But then people, as I like to say, get back to their desk and get back to business. Right. And generally you see a more rational market kick in. People find values, they find trading levels, and then you move on from there. And so it's the catch of, what do we do in the next year to year and a half? But it is not to me, I don't have a long-term view that the party is over for real estate.
Right. I would agree. I would definitely agree. There was that lag where people were just the industry and the individuals are just kind of figuring it out.
That's right.
Figuring out what to do next. So to wrap a couple of these questions together, we have the Ukraine, the issue in Ukraine, the war in Ukraine. We've had the pandemic. We have inflation, all kind of on each other's tails. Mm-hmm. How do you feel that our industry adjusts to that? The capital markets adjust to that?
How do I feel that we will adjust to that?
Yeah.
It really goes back to some of the things I was just walking through. I mean, I think that what's going to happen is, from an underwriting standpoint, exit caps are going to be challenged, right? Exit caps have been moving kind of in one direction for the last, it's really been a secular decline for, I'll say 20 years now, right? Yeah. And so, I reference again the beginning of my career where garden apartments were underwritten at 8.5 caps, right? And so now those numbers are, kind of 4 and 5 caps.
Right.
I don't think we're going back to 8, right? To make the point, I don't think we're going back to 8. But if you have an asset that traded at something south of a 4, and your business plan said, we're going to do value add, we're going to do a lease up strategy, and as we get through that, this asset that I'm buying at current income of a 3.8, 3.9, 4.0 cap rate, I'm going to get that up to a 4.75. That would be a huge return. But if But if the market shifts, and I'm just arbitrarily saying the market shifts, and now your asset class is now trading at a 5, and your business plan was predicated on getting to a 475, that's where on one side of the trade, people will lose value. And then on the other side of the trade, people with capital will be able to step in and buy at, I won't call it distressed situations, but opportunistic, definitely situations. So I think that our lenders are going to take a pause, figure out where levels are. I think that will slow down some of the things in the construction pipeline. I think that the real issue, and I talk a lot from a multifamily perspective because at Gateway, we've been really focused on multifamily over the last 4 years. But just as you kind of even look out further than that, the uncertainty around the office market, how much space do you need per employee? How much parking do you need per employee? Those are questions that the entire industry is trying to figure out. And so I think that as rates are moving, I think it actually gives people an opportunity to pause and refigure, what their business plan will be. So let me stop there. I'll keep going on that one because it is one of these things where now you really do have to think through your business plan and how you present that to investors.
Okay, perfect. Definitely a time for reflection. Let's see. So here's an interesting question. What metrics do you use to determine what cities are Sunbelt growth markets as listed on your website, or where do you see the capital markets affecting what cities you go into?
Yeah, sure. So first of all, to answer the question about which metrics, we're looking for two things. We're looking for population growth, which is why a lot of groups are chasing the Sunbelt markets now. But we're also a little different than others, and we're actually looking at places that are where workers are constrained from a mobility standpoint. And what I'm saying to you is, you take places like New York City, where a ton of headlines around people leaving New York and will New York come back. New York is coming back. That is my one definitive call. New York is coming back. How and when and what it looks like, different answers. But let me make my point a little more crisply. But the support functions in New York that are serviced by the people who live in Jersey City, Paterson, New Jersey, Bayonne, different parts of Long Island, Mount Vernon, you name it, all of those communities around New York that service the New York that we know. Mm-hmm. Well, those communities don't have the same mobility that the masters of finance do. So they didn't have the flexibility to move to Florida for 6 months and figure it out. And so I think there's a very interesting trade to be had on buying higher yielding assets in markets where you have high density, older product, where people are looking for an opportunity for a better living condition, but are not income, career mobile enough to say, hey, I'm going to leave Jersey City and now move to, Atlanta. So we like that trade in a few places, and that exists, believe it or not, that exists in most of your older major cities across the country. So if you look in Boston, if you look in suburban New York, If you look in some of the suburbs and some of the inner suburbs of Chicago, definitely San Francisco, Oakland, the LA area, those are places where you have large communities where the population has settled from a numerical standpoint, but they need higher quality housing, and they're going to be there. So we like that play.
That's great. So you mentioned it. Let's talk about the luxury market, that market rate plus market, and how that's not necessarily being affected, but how that's growing. I feel it's on an upswing as well.
So the luxury market is interesting, and you have to define, as you talk about luxury, you have to define what luxury is. And what I'm saying is, when people think of luxury, and I'm going to talk about multifamily, I'm going to talk about Class A office, and I'm going to talk about retail all together, because really what you're talking about is catering to a particular demographic that is looking for a certain experience and certain amenities. And what I'm saying is, I think that retail is changing. I think office is changing. And I do think how and where people live is changing all at the same time. And so I think that what you want to do is look for a physical asset where you can create the type of experience that luxury seeker is looking for. But I don't think that it has to reside in a 50-story office building anymore. I don't think it has to reside in a 30-story apartment building anymore. And I don't think it has to reside on Michigan, Madison, Fifth, Rodeo, Peachtree, Mass Ave. I don't think it has to reside on those particular streets anymore. I think that there is going to be, I think that what's growing is a situation where people are looking for the experience in a more convenient location to how they live the rest of their lives. And so I think that is something that we're trying to get our heads around. How does that show up? And that has pushed us to look at different parts of major cities that I pick on Atlanta because I'm from Atlanta. Love Atlanta. And all of the growth that's happening in Atlanta, we love it. But then you have to look at, well, where within the city is it actually happening and who's moving where? And 10 years ago, I would have told you, buy any piece of dirt in Buckhead you can and you'll be fine. But now I'll tell you, go not even to Midtown, go west of Midtown, go near the stadium, go to Castleberry Hill. It's shifting. In different markets around the country, it's shifting. And so when you say Atlanta, when you say Austin, when you say Charlotte, when you say Nashville, those are big geographic areas. And the area that may have been kind of the flagship 10 years ago may not be that flagship going forward.
That's interesting. And how would you say that has affected development?
I think that it is giving people who are doing desktop underwritings at the large fund shops around the country, it has given them the confidence now, or at least the flexibility to take a deal to investment committee that is not at the traditional main and main. Mm-hmm. And people talked about that over the last couple of years from the standpoint of flight to the suburbs. And that's really what they're saying. We used to be at main and main if we were any one of the, I'm going to call it the large 50 billion plus asset managers that invest in real estate. Mm-hmm. When you look at what those shops were investing in, quite often they were all investing in a very similar product and in very similar locations around the country. And this has given people the opportunity to rethink, where can I get long-term yield? Where can I get long-term returns? And maybe that's not happening at my 10-year-old main location. In DC, I heard someone saying, it was funny to me. They said, yeah, I never want to live in Georgetown. I kind of smiled and kind of scratched my head, because Georgetown
Right.
is it is that place in DC that was, kind of where you want it to be, and by extension DuPont Circle, right, where you want it to be. And there's a real talk about that, that 25 to 32-year-old wanting to be in a different part of the city.
Mm.
And the last thing to tie us back to the capital markets that we haven't really hit on is just the ability to buy a home. Because rates were low, even though asset prices were increasing, there was some ability and we saw ability for people to start catching up and being able to buy homes. But now, as rates are increasing dramatically, mortgage applications are down. And what does that mean? That means that more people will be renting over time. And now you get right back to what I was saying about, okay, I still want the feeling of working in a Class A office building. I still want my high street retail. But if I am now working from home, and home is an apartment, and I'm working from home 2 days a week, even if it's just 2 days a week, well, for those 2 days a week, I'm not necessarily looking to have cold cuts, for lunch, and I'm not necessarily looking to have, something made on my stove at home. That demographic is still looking to go out to eat, do a little shopping, and that needs to happen closer to where they are actually living, if they are not all moving towards the central business district 5 days a week.
Right. So there's a shift in the way people are thinking about their homes, and then the way investors and developers essentially are thinking about placing those homes in different areas, kind of outside these, in the major cities, but in almost a micro market of these major
Absolutely.
cities. Right.
Absolutely.
Brilliant. So we've got a ton of questions here, but we're gonna start to wrap. And here's an interesting question for your storied career, Terrence. If you had the opportunity to go back when you were just starting your career, what would you change your path and some of the choices you made, and why?
You know what? So yes, I absolutely would. And here's what I'm saying. Hindsight is 2020, right?
Right.
So I've had just the most exciting career that you can have, right? I have stories about being a fly on the wall for some of the biggest deals that have happened in this industry, and I've had a chance to kind of actually be at the helm of doing a couple of those myself, right? It's been fantastic. But with everything I know now, are there things that I would have done differently? Absolutely, because I would have gone back and basically bought the lottery ticket that I know exists. If the first time. Look, I won't do a lot of anecdotes, but to answer the real question that the person is getting to, look, I think that real estate is a phenomenal industry. I would not have picked a different industry to come into. I think it gives you the option to use so many different skill sets, right? We have marketing people, we have equity capital markets people who are out talking to investors every day, right? We have pure finance quant people, we have developers, we have project managers, construction managers, and everybody gets to hold hands around a project and say, that's my deal, you know. And so I think that that just makes this a fantastic industry for everybody to be able to show up and be needed, and then actually have real value around the table. So I couldn't think of going into a different industry than real estate. And so from that standpoint, to answer your question, no, I would not change a thing from that standpoint.
That's awesome. That's awesome. Terrence, thank you so much for your time with us. Um, you've had an amazing career, and your insights on the capital markets, the past, present, and future of the capital markets has been absolutely amazing. Thank you, and I know my class will thank you.
All right, glad to do it. Really enjoyed it.
Can't wait to have you in next time you're in the city.
Let me know.
Take care.
All right, thanks a lot.